first, let's talk a little bit about the path to ESOP sustainability and the case study that we want to talk about today. So in this particular case, the company in question had a stock price that had been increasing in the double digits for many years in a row. Most of those years were actually in excess of 30% per year, and many of the other years were in excess of 15%. In this particular case, most of the allocated stock was actually in the hands of departed participants. And so of the allocated value within the ESOP, most were for employees that were no longer active employees of the company. The company obviously had an issue with this as the value was growing significantly, and most of that value was growing for people that were no longer there. They also looked inward and said, we actually have a very strong cash position, significant amount of cash on the balance sheet that's available. And could there be a better use of that cash while we're sitting here watching departed participant accounts grow at 15 to 30% a year? The company had an internal target of an 8% contribution of payroll to its ESOP participants. What we'll find through the study was that that was the cash contribution level that was being communicated and expected. But when you included the value of recycled shares, it actually pushed the annual benefit level up above 12%. And a repurchase obligation study that they had done showed that they were going to need to make cash contributions well in excess of 10% per year to manage the repurchase obligation. And so there was a disconnect between the benefit level they were communicating, the benefit level that they were actually experiencing, and then the cash requirement that was going to be necessary to fund repurchase obligation going forward, which was in excess of the desired benefit level. So given all of that, management came to us and they said, we really need to stop having the tail wag the dog here, that our repurchase obligation is driving our capital decisions. And we need to understand better how to manage a benefit level, what to do with our cash in order to get there and put us on a trajectory going forward that's really optimized and fits with the benefit level we intend to be providing. And so they asked us, what should we do with the cash in order to get the ESOP to the right benefit level going forward? And if we use that cash to cash out segregated participants, what repurchase strategy should we use going forward? Because historically, they were using 100% recycling only and thought it was time to approach this with a little more sophistication to help manage it going forward.